Hello and welcome to our latest episode of the Money Talks podcast in association with Royal London. In today's episode, I'm joined by Gregor Sked, Senior Technical Manager at Royal London, and our special guest, Paul Roberts, Propositions and Distribution Director at CI Expert. So thank you both for joining me today.
Thank you for having us.
Yep, looking forward to it.
So Royal London is the proud sponsor of CI Expert's Critical Thinking 2026 report. And obviously, Paul has joined us today to discuss the key themes and opportunities this highlights for advisors. So something that stood out to me from this report was that only a minority, 22%, know how long their employer's sick pay lasts. And while there's a general misunderstanding of what income protection typically covers, when this is explained, its perceived relevance increases. What do you think this tells us about where the real advice gap is?
It's complete, and yeah, thanks for having us again. It's exciting to have Paul here from CI Expert and actually get to drill into some of these stats from the latest critical thinking report. I think the point that you mentioned there is really quite stark. One of the challenges that we do see is that concern of understanding what income protection is. And I think the idea as to whether or not it's going to be a growing concern is one that I think we'll wait to see, really. I think there's no surprise that there probably are a lot of patches of uncertainty and confusion when it comes to income protection. We've seen the FCA highlight it within the Pure Protection Market Report around the lack of understanding. And I think what the gap that we're seeing says is it's not a gap around getting the conversation started. I think it's around the understanding and the clarity of what it is that we are being discussed. So if you're saying there only 22% know how long their sick pay lasts for, I think on that most people probably aren't making what you call an informed decision about the income risk that they've got. A lot of the time, it probably is a bit of a guess. And thankfully, I would say advisors are key here. Advisors are often the first person that's there to make that individual understand those risks and the assumptions that they might be making. I think the really encouraging part is that when you see how those perceptions change once income protection's been actually explained, where it's there to replace income when sick pay stops. So the perception of the relevance of the product really changes and it really shifts. One of the things I really took away from the report was that 43% of individuals say it felt more relevant, i.e. income protection, after they had the explanation as to what income protection is. And I think that rose to about 61% of Gen Zs and 64% of millennials. So the appetite is certainly there, but it's the understanding that's missing.
One of the most interesting things is when consumers look at what they actually have and what they believe they have and what they can claim from and how that relinks into an income protection plan in particular, there is a confusion between the understanding of cancer, heart attack and stroke being the primary claims that you can make from an IP plan. Against the likes of serious physical injury or musculoskeletal health or mental health or anxiety and depression, many of the other conditions. So it's that lack of understanding at consumer level which really underpins the propensity for somebody to buy an income protection product. And clearly, when properly explained, as Gregor has just mentioned, the likelihood of a younger person taking out an income protection plan grows disproportionately as a result of the advice they've been given. And in that way, everybody listening to the podcast can make a decision in your own mind about how you approach income protection with your clients, the conversations you have with them. In the Critical Thinking 26 report, you'll see a lot about reframing. And reframing is our way of saying a different way of thinking about something, a different way of approaching it, and using different language to explain the problems that not having an IP plan or a critical illness plan might cause. Most of us assume we won't claim off anything, but for those who do, having both an IP and in particular a kick plan side by side covers a lot more eventualities, protects a lot more financial resilience than having one or the other. But when an advisor correctly explains something, the consumers understand it, so their likelihood to buy the right product for them increases.
I think the language is key there, isn't it? We're saying, I mean, they're not necessarily saying no, they're probably saying, I don't know. In most cases, it's I don't really know what it does and what it's actually there to do.
Yeah. I think awareness is a big piece of this, because you can't predict the future. You don't know what might happen, but understanding that having that support in the case that might happen is important. And the report does paint a clear picture that Gen Z, I say Gen Z because I'm online, but also Gen Z, expected mixed or non-linear careers, with people wanting cover that can move with them. Do you think income protection is designed for modern work, and what does that actually look like?
It's an interesting one. Certainly a lot of traditional assumptions that we would maybe think about income protection being targeted towards is probably becoming more updated. So a stable employer, static income, linear career progressions, I suppose those are becoming a little bit more outdated. I mean, people are moving jobs and maybe looking more flexibly. They want something that will grow with them and grow with life as it changes. And I think, again, that's something that the report highlights a lot, is the importance of the cover, but also making sure that the importance of the cover in terms of what it can do. It can move with you between jobs and employer types, and that, again, a clear understanding of how it works. If you do maybe change your working pattern, your working roles, and what worth and how you work. I think modern working, in my eyes, I wouldn't say is about jobs changing. It's about life stages changing, and actually thinking about that more broadly. If somebody becomes a parent, that's probably one of the biggest shifts in somebody's life and their working pattern and how they earn and how they cope with these types of disruptions. So I think actually something that I know Paul and I have spoken about in the past is, how do we position that in terms of parents thinking about how do they protect their children, and they often, that's, for many of them, will be often the point where they start engaging with risks for the first time, and actually I think that naturally opens up the door to the bigger question as well. If my child needed me to stop working, what happens to my income? And children's cover can be a bit of a catalyst to that as well, not because it's replacing income protection, but because it makes parents think about dependency, time off work, and actually the financial impact of care. And I think for a lot of parents, as myself, a very new parent, the thought of a child becoming ill emotionally is an incredible strain, but financially as well, that's going to be a huge impact. Your medical bills, it's lost income, time off work, reduced hours, maybe stepping back from work entirely, and that's where income protection can feel real. And we're not necessarily thinking income protection as the product, but it's other forms of protecting that income. Could be children's critical illness. It is critical illness. It's it's not just the phrase income protection as the product. It's much more broad than that. And I think that's where a lot of modern protection conversations probably need to be stemming towards.
The point you make about children's critical illness or income protection for adults or parents is an interesting one. And as we all know, an income protection plan is unique in the fact that, so once the policy is taken out, it's there for the duration and can only stop when clearly someone was to die or they stop paying the premiums or it reaches the end of their term. So having children's critical illness cover linked onto an IP plan for a parent is possibly the best place to put it. Because if you link a child policy to an adult kick policy and the parent has a full payment claim, that plan stops. Now, in income protection world, that doesn't work in the same way, because the adult can make as many claims as they can or they need to. And if they've got children's cover, the children's cover stays as well. So there's no limit, if you like, or no potential to lose the children's cover because a parent has made a claim on their policy. Now, if we put that forward into modern working practices, and with my 3 children all self-employed, they all do different jobs, they have various different careers, pathways they're going on, but they will always work for themselves. So they always have to provide for themselves when it comes to IP and the protection policies, the portfolio of protection policies we're trying to create financial resilience. So they need flexibility to be able to take those with them. And part of modern day lifestyle and the way that we change the way we work is also the change in the way we protect ourselves. And some of the clear messages within the Critical Thinking 26 ability to have conversations and for advisors to approach consumers, particularly those who are self-employed, in a way that's different to allow them to focus on what's most important to them, and for the advisor to put into place a portfolio that their client then can choose which parts of that portfolio they have today, which parts of that portfolio they might want to have into the future and become almost aspirational to have. And then when they're in the state to have that as part of the annual reviews that all, all good advisors will take part in with their clients on an annual basis to bring these into the topic of conversation and tell them in advance that they want to speak to them about these. So they're prepared and ready for the conversation that they're going to have, not just turn up one evening and say, look, I want to talk to you about this, with no opportunity for the client or clients to reflect on what's valuable and important to them in the future. We aren't going to go back into a world of everybody being massively employed and working in the way that we did in the past. And we have to support and encourage the entrepreneurs in this world by putting into place the protection plans, the financial resilience plans that they need around them to help them shape their futures.
Mm-hmm. And talking about those entrepreneurs, the research reveals that advisors find self-employment and mixed income roles the biggest barriers to securing suitable cover. So what's the smartest way the market could reduce this friction without undermining robustness?
It's a good question, and I'm not surprised we're looking at self-employed individuals, because I would say self-employed individuals are the most at-risk category of workers. If they are off sick, if they're injured and they can't do the job. And I think one of the biggest barriers that we see with self-employed clients isn't necessarily it's not to do with the willingness to protect their income. That's certainly there. It's probably the uncertainty. If you're self-employed, I think people often don't necessarily know when we're looking at the calculation for their income protection, so what real income looks like after the fixed business costs, tax, national insurance. So it can often be quite hard to visualize what actually needs to be protected. And the research that we're looking at, we see advisors want more flexibility for self-employed clients. I think in practice that means solutions that do recognize fixed costs, variable income, because that's what reflects the self-employed individual's work in practice. When I know for a lot of self-employed people, income protection often only clicks when we do translate gross earnings into what actually lands in their pocket. Once you do that, then the question isn't, then can I afford it? It's, could I cope without it? And I think we're seeing about 4.5 million people in the UK self-employed. A small proportion of that have got income protection. So when we're thinking about opportunities, self-employed clients really are the one of the most important group of category of workers that I think need to be made aware of the income protection solutions that are there.
And when we were looking at the whole point about affordability and perception of value that a protection policy brings, in the past, it's always been done on a premium basis. We're going to spend X amount of money on buying a protection product you can put a monetary figure on that. But in the report, there's an emphasis on the percentage of a person's total income and what percentage would they be prepared to invest in providing financial resilience for the future. And in the stats, you've got 12% say they invest about half of 1%, 18% say 1%, 2% say, 13% say 2%, and 7% say 3%. Mm-hmm. Now, 3% of an average person's income in the United Kingdom is actually quite a lot of money. So when you look at the average premium that's been an average protection plan would cost in monetary terms, and then compare that as a percentage figure of 3% or 2%, I think there would be tremendous surprise in how much you can actually buy for 2% of your annual income. And if you've got 20% saying they're prepared to invest 2% or more, of 5,000 consumers. That's quite a lot of people. So it's really interesting to reflect on, for the advisors listening to this, do you talk in premiums or do you talk in percentage of income? And how do you use that change of language to create opportunities for you to have meaningful protection conversations that you otherwise wouldn't have had if you'd have gone down the fixed monetary route rather than a percentage route?
It's an interesting way of looking at it, because I suppose when you are thinking about your other forms of financial planning, if you think about your company pensions, for example, you will be having those conversations in the form of percentage. You pay X percentage into your pension every month. Can that conversation translate into the income protection space? I think it's really interesting.
And I wonder whether if we change the language and reframe that language around percentages, we'll get a much better outcome for consumers. One of the great opportunities for us all here is to, and I know Gregor mentioned it earlier on, was the way we view the children's critical illness element of a KIC plan at the moment. And historically, and I'm sure most people listening to this would view it as a smaller version of an adult plan that provides a lesser cash amount should one of the children or more than one child be diagnosed with one of the eligible conditions within a KIC plan. But what is it really doing? What it really doing is giving the parent or parents the ability to take time off work that they otherwise may not be able to do if they're employed. The only way that I understand it's possible to take time off work if you're employed after you've used up all your holiday allowance, unless you get special dispensation, is unpaid leave. If you're self-employed, you have no alternative but to take leave yourself if you can afford to do it. So are we looking at creating opportunities for a different use in the way that or the different framing of children's critical illness, and view it as an adult parent income protection type plan that's used to give them the flexibility and financial resilience to take time off work for extended period of time if they need to? Or do we continue to view it as a mini version of the adult plan and simply mirror it? My view is that it's very much an adult income protection type plan that gives parents the ability to take time off work for an extended period of time should they need to. And I'm sure every parent listening to this, if something happens to your kids and you need to look after them, you'll do absolutely everything you can to do that, whether you take paid leave or not. And what we're doing here is simply providing a financial comfort blanket, as one of my colleagues used to say, that you can wrap around the family so that when a parent or parent needs to take time off work to look after a seriously ill child or children, that they have the financial resilience to be able to do that.
Again, not diverting too much, but we talk a lot about opportunities in throughout the last few minutes of the podcast. And no doubt if you're an IFA, if you're a wealth advisor, you're probably going to be hearing a lot the growing importance of protection in wealth planning because of recent changes with pensions and IHT, BPR, IPR, and you've probably been inundated with reading material and listening material that talks about we need to be thinking more about protection. Yep, if you are a wealth advisor, there are a lot of more solutions out there that are probably going to be further up the agenda. But I said that also opens up the door to talk about income protection, not necessarily directly with that client exactly themselves, but it could be their children, their grandchildren. And we've got to look through these different avenues that we're maybe now having conversations with about protection, and where does something like income protection or children's cover sit within the wider family? And I think that's another opportunity worth exploring.
I think if we expand that one, Gregor, then when you're having a wealth portfolio, what we're doing here is we're having a wealth portfolio. We're just including a different product into that wealth portfolio in the same way as we would apply a different fund or change of fund, or changing my attitude to risk would alter my perception on value or my investment risk moving forward. And what we're doing here is we're doing the same thing. We're just putting an IP or a KIC plan, and if eligible, into your portfolio in the same way as you'd make a further investment into a different fund in a pension or a bond or whatever else you've got. So it forms part of the language. And if we're used to using the language of portfolios, then we're simply adding another option within the portfolio for that wealth advisor or whatever type of advisor you are, to have that conversation about, well, we're not making a protection plan, we're adding to your wealth portfolio and financial resilience, and using all the language and terminology that you're familiar with, just adding in slightly different products into that range.
I suppose the question to leave with is, is protection the missing asset class? Is it the asset class that we need to be thinking about in those portfolios?
Yeah.
Well, Greg, that is an outstanding observation. And if that's what it takes to change advisor behaviors and innovate advice, then let's look at it as that.
Mm-hmm.
Well, this was a very enlightening discussion. Thank you both for talking with me today. I think that our audience will definitely find it very useful. And for further resources, they can check out the CI Experts Critical Thinking 2026 report. Paul, you touched on a lot of it, but I know there's more that advisors can get out of it. So it will be linked in the description bar and in the post for this podcast. But thank you so much for joining me today, Paul and Gregor.
Thank you very much. Enjoyed it.